Hey everyone, this is Jay Soloff from Investors Alley, and welcome to our options trade of the week. So we're going to look at an interesting trade and then show you how to do a similar version to it in a brokerage account. So first off, let's find said interesting trade. I like to look at Market Chameleon's unusual options page and then sort by volume. And the very first one on here is Uber. Now, if you are following Uber at all, the rideshare company is really known for racking up really big losses. So earnings were very interesting in that the CEO said they expect profitability by the end of this year, which is pretty crazy. And also the losses, were narrower than expected. So some pretty good news for Uber. It is up 10% today and has been on quite the tear, which we'll see later. But I saw a really interesting trade that I wanted to see if I could dig up here while we bring up the trades. And then I will sort by quantity so that the bigger trades come to the top. And I want to show you this three-way trade. And now I will show you how to do a simpler version of this, but I wanted to show you first the original trade, which was quite interesting. And here it is. This one in particular, these three that were done at the same time at 3:25 p.m. and they were done January 15th, 2021. So a little less than a year from now. So this is a three-way spread. And this is the sort of thing you see pretty popular amongst position traders trying to keep their costs low. So usually professional like funds or something like that. And what it is selling puts to finance a call spread. So someone sold the 33 put 2,400 times and then bought a call spread, 42.60 call spread, meaning they're buying the 42, selling the 60. All right, so what is the point of all this? Well, they expect Uber to go up over the next year. They're buying into this company is starting to look a lot better, and this price is going to go up. So with the stock at around $40, if you were to buy the 42.60 call spread that expires next January, it would be pretty expensive because you're buying a call that's $660 for just one, and even though you're selling the 60 call for two, you're still spending about $4.50, which is quite a bit. So if you wanted to reduce that cost even further, you could sell the 33 puts, which is you collect that $3. And now you're only spending $1.50 for this whole thing. Granted, you have risk if the stock drops below 33, but if the stock stays above 33, your risk is that $1.50. Of course, that puts the break-even point at 43.50 for this trade, and anything above that up to 60 is pure profit. So there's additional risk with selling puts. However, if you feel that Uber is done being a below 30 stock, or 33 in this case, then you feel that this is pretty safe and that it's a good way to reduce costs. So let's take a look at that in a brokerage account. So first off, you can see here's the chart. Uber has been on, actually it's been pretty well in an upward trend for a while now, and then it jumped 10% today. So if you think that it's not going to go back below this level in the next year, then selling those puts are fine. Now, if you are bullish and you don't mind spending some money, then you don't need to sell those puts. That is, selling puts like that is a risk. You probably have to have the cash in your account to cover anything under 33 if you were short the shares. So if you don't want to deal with that sort of thing, you could just do the call spread, and I'll show you that. Now it's expensive, right? The 42.60. So what we're doing is buying this strike and selling. So here it's generally called a vertical spread or a call spread in your brokerage. So we're buying the 42, except we want to sell that 60 strike. So we'll put that in there, and that's $4.40. So $440 for one, or $4,040 for 10. So that is one thing you could do. Now, this person sold these puts here to help finance it, but if you don't want to deal with that, you could also, let's say, make just a narrower spread. Let's say do the 42.50, for instance. The 50 strike is here. So now you're spending only $2.60. So that's a little bit closer. This trader spent about $1.50 on the call spread financed by puts. You could spend $260 per spread, which is a lot more reasonable, and still have a chance to make decent money if this thing goes up to 50 or above in the next year. So that's another way you could do it without having to worry about the short puts. But just some interesting stuff going on, very bullish on Uber. And if you want to learn about this sort of thing, you can check out some of my materials. I have a entry-level product that's only $49 a year. You can find the link on this page. It's a good way just to get introduced to options and learn some of the basic concepts before you expand into more complex stuff like this. So check that out if you are interested.